Thank you for joining me. I'm Alex, and I would like to talk about Zoom today because I think the first analysis I ever did was about Slack, and Zoom kind of sort of competes with Slack in certain aspects at the very least. And they were one of the trending stocks today on Yahoo Finance, so I figured it's time to have a look at that. And what they do with a company called Zoom Video Communications is video communications, which is amazing. So they have one of the most amazing stats, and you think this is like clickbait, but it's truly amazing. So they do video communications, which means that video conferencing, especially when people like work from home or are remote employees or two different buildings or two different continents, kind of collaborate and have a shared phone call, video conference, whatever. So at where I work, we do a lot of things over Zoom that is not otherwise possible. We used to have a Cisco thing rather than Zoom, and I don't know what we used before that, but anyway. So current price is $69, which gives them a market cap of $19 billion, which is kind of ironic when you look at the earnings, but dividend is obviously zero because the company is 2 years old, and there's not going to be a dividend in the foreseeable future, and don't rely on there to be ever a dividend. So revenue $331 million, earnings $12.9 million, and a PE of 2,402. And I have never seen that. I thought Netflix was ridiculous at 300. So obviously there's no problem there with the PE that high. You would think that when a company makes the move from being from having a loss to being ever so slightly profitable, it's obviously a good thing, and they're there-ish. But obviously they have a long way to go to a decent PE. Total assets $335 million, total liabilities $187 million, which gives them a total stockholders' equity of $167 million. And that is down 700% because it went from negative 26 million to positive 167 million. So technically it went negative. So to sum that all up, revenue growing 100%, and it grew 100% before that. So if they continue a growth of 100% for the foreseeable future, then the market cap will be justified in 10-ish years. So 10-ish years of 100% growth, and you have a reasonably justified market cap. So for a growth investor with an extremely long horizon, that might make sense. It's also possible and even likely that they will exceed 100% growth rate, because obviously there's a bit of a boost once you get a recognizable company, and there will be many more people choosing your service over other services because the name finally is there in the open, and you don't have to like advertise to people making the decisions. Also, once you get a few big clients, then it's easy to raise the prices or have prices in the first place, and boost the revenue a lot from there. So I work at a really big company, and we use Zoom, and I assume that it's fairly cheap at this point, but it would be easy for Zoom to raise the prices to even something reasonable. So I talked about Slack, and the price for Slack is not reasonable, and I'm pretty sure Zoom is cheaper. because I would assume that that whole revenue would come from my company right there. So anyway, I do think it could make sense for a growth investor with a fairly long horizon to invest in this company. However, I really don't think that the current price is justified at all in any way, even with the current growth. So, obviously, waiting 10 whole years for the valuation to even begin to make sense is almost stupid. So, I would say that no one should buy this company right now and wait a year, see what the numbers are, or at least wait a few more months to see this year's numbers, but they're not that much better. But wait a year, see what the numbers are. If they can exceed the 100% growth rate, and if they can exceed the 60% growth rate for the earnings, then it might make sense to kind of get in at that point. But for now, I think that waiting 10 years for a reasonable valuation is not advised at all. I don't even think that Amazon was so overpriced at any point. So, in short, I think that they're a profitable company. I think they have a good product. I think they have a good growth rate. I think that things are going well for them right now. I just think that they're vastly overpriced. And so they're just under $70 a share right now. I would probably buy them for $7 a share. But I don't think I'd buy them for $10 a share. So if they lose 95% of their value, I'm definitely picking up some shares before that. Gonna wait and see where things are going and maybe go from there. So that's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.